For more on what to expect from the markets this week, we want to bring in Andrew Sheets. He's the global head of corporate credit research at Morgan Stanley. And obviously, Andrew, those numbers that we got on Friday, those stronger than anticipated jobs number, that really set the tone and pushed the S&P 500 above 6,000. What do you hope to get out of the inflation data this week?
Yeah, thank you. It's great to be here. So I think this is a pretty kind of interesting moment for the inflation data. We've had pretty good inflation data in the U.S. over the last couple of months. It really hasn't shown much, if any, real impact from the tariffs. But going forward, we think the inflation data is going to start to pick up. If I look at Morgan Stanley's forecasts in the U.S., we have the inflation data kind of continuing to steadily rise over the summer into the third quarter, while kind of inflation elsewhere, inflation in Europe declines. So I think this inflation report and really the next couple are going to be really important for, are we really going to now see some of the inflationary impacts of tariffs and other factors come through, or is it a little bit of a mirage? Is the data that we've been getting the more accurate picture?
You don't think, though, that we're likely to head back to the April lows. You think that the market's going to power higher from here, and I think 6,500 by the middle of next year is your target?
Yeah, that is our thinking. So we do think that, look, we think the inflation data will pick back up a little bit. We do think growth is going to slow some. But importantly, we think the equity market is forward-looking, and we think the equity market is going to look ahead to a better rate of change. We've already started to see some of the earnings revision numbers get incrementally better. We think that the dollar has been weak. We think it continues to be weak. That's a tailwind for earnings. And so we think the market is going to see better earnings revisions. You've already, we think, kind of priced a recession, priced the usual drawdown back in the April lows. And so a better rate of change, better trend on earnings revisions, tailwind from a weaker dollar should help S&P earnings hold up. The Fed's going to be cutting over the next 12 months. We don't expect a recession. Usually when that happens, the multiple doesn't decline. And so that's why we think the S&P can move up to kind of 6,500 by the middle of next year.
And what does the Fed do in your base scenario?
So the Fed is on hold. We don't think that the Fed is cutting this year. And we think they're not going to cut because, as you alluded to, this inflation data that we're going to start to see over the next couple of months is, we think, going to be kind of uncomfortably increasing while the labor market is not yet showing enough weakness to cause them to move. But because they wait longer, because they don't cut this year, we think they have to do even more next year, and that drives more aggressive cuts in the second half of 2026.
I was reading something over the weekend, I think it was from Torsten Slok, that the rapidly growing Treasury issuances are kind of crowding out all the other types of credit growth. I mean, you focus on corporate credit. Is that the case?
Well, I think you are really seeing a really stark contrast between the fiscal picture of governments, especially the U.S. government, and the fiscal picture of corporates, which is, the government fiscal profile is not good. The corporate fiscal profile is good. And you've seen, very strong earnings from corporate America. You've seen very restrained aggressiveness, even as the equity markets have been strong. You haven't seen as much M&A. You haven't seen as much debt growth as you usually do. And I think corporates are looking at both kind of the higher level of interest rates and kind of the uncertainty around the tariff backdrop and taking less risk, taking on less debt than they otherwise would. So, yes, I think there's a pretty interesting kind of contrast there. And because, we focus a lot on credit spread, obviously the difference between the corporate yield and the government yield. But because of those divergent fiscal pictures, because the government fiscal picture is that much worse, I think that's a factor that can keep those spreads lower, tighter than normal over the next 6 to 12 months.
So people trust companies more than they trust the federal government at this point?
Well, we're not quite there yet, but we've started to see instances where in individual cases that is the case, where individual corporates are starting to trade a little bit inside the government. And, I think if we do look at the government issuance picture, we think other factors can ultimately cause yields to be lower over 12 months. We think ultimately that Fed cutting is a pretty powerful force. And so we do forecast bond yields to be lower in 12 months' time at Morgan Stanley. But the fact that the dynamics are different, the fact that, corporates are restrained, corporates have the option to borrow, they don't need to borrow like the government does, is an advantage.